Hello value investors, thank you for joining me. Today I want to talk about Intel and why I believe that Intel is overvalued. So we're going to touch about its revenue growth rates, then we're going to talk about its prospects ahead into the next coming quarters as we look for the divergence between that PC-centric business and the data-centric business. Then I want to talk about its value operating leverage, because I think that's really key here to the whole theme that brings it all together, and we're going to talk about its valuation. If you haven't done so already, don't forget to check out my marketplace. It's called Deep Value Returns. I'll tell you the stocks I own and why, with a balanced argument for the stocks I own. So let's get started. So the thing with Intel is not only that Q4 is looking quite rough to be negative 14% year over year. It has more to do with two things here. Firstly, as we look to the quarters ahead, and it starts lapping with this year's COVID environment, revenue growth rates are going to be quite negative. So that's one thing to keep in mind. The other thing to keep in mind is that the biggest driver in this quarter was really its PC-centric business, which was up just 1% year over year. The rest, which is like the data-centric business, is looking to be quite down. It was down, as you can see here on the screen, with memory down, and you can see that data center was down. And it's really important here because this was the driver for the past several years for Intel, as it was looking to spin away from its legacy business. That although it's very cash flow generative, the PC-centric business, investors were looking for growth and they wanted more Intel to be positioned as a data center business, and that's really not taking place right now. So there are questions about whether the competition is really taking away some market share. I'm not going to go too much into that, but I think it's just something to bear in mind. Moving on, I want to talk about its operating leverage. So here's the thing, right? When Intel's revenue growth rates are growing, as it was last year year over year was up 8% year over year in Q4 19, okay? So it was up 8% year over year, and that lent itself to its non-GAAP operating margin being at 35% non-GAAP, 35% operating margin. This year, if we're seeing negative year over year growth rate, so we see negative 14% for Q4, that's lending itself on the guidance towards its operating margins being 31.5%. That's more than 400 basis points compression year over year. So that's when I talk about its operating leverage cutting both ways. As the top line expands, its margins expand, and on the same way as its revenue growth rates compress, that means that its operating margins compress, and that means that its free cash flow will also compress over time. It's not going to necessarily happen next quarter, but it's going to mean that over time it's going to reverse. So right now the free cash flow for this year is looking at 18.5 billion. That looks quite nice, because that puts the stock trading at approximately 11 times multiple. And that's quite cheap. Having said that, without it having strong revenue growth rates, the business, that free cash flow is really going to start compressing. So this is what I wanted to point out too, right? So last year, its free cash flow in Q4 was positive 5 billion, right? This year, it's going to come to around about 3 billion. So it means that it's not only going to look quite negative year over year, but it means that the whole story that it's been making approximately 5 billion every 90-day period is going to reverse. So it's going to be a difficult investment to keep hold of. And I always tell my marketplace members, it's bad practice to really sell into negative earnings results. You typically don't do that. I always tell my members, it's important to kind of sleep it off and trying to come back to it. But there's not a lot here worthwhile holding. I hope you found this video useful, and I'll see you next time. Bye-bye.